Good evening. I'm Daniel Colton, and today we're going to be talking about sensitivity analysis and capital budgeting in the perspective of starting a new product within a company. In order to do that, we're going to want to think about the qualitative thought processes that come with, considering a new product, the kind of bounds that may contain, as well as inputting research, data, using that data, and then some of the thought processes of risk. The first thing with the qualitative thought processes is, one, with your product, what kind of things are going to go into actually starting that product. So for example, we can just think of things like, how big is it going to be? How big is it going to grow? Are we expecting to sell 10 products a year? Or are we expecting to sell 100 products a year? What's the difference between how much it's going to sell today versus tomorrow? How much are we going to charge for the exact product itself? As well as things as like, how much is the product going to cost us to make and to generate? With that comes profitability, understanding how much profit we're going to make from each product. And with profitability comes the ideas of, well, is there another product that we could sell that would be maybe more profitable or be better for us? Additionally, with those products comes the competitive market that we may be in. Are we going to release a product into a competitive market where there's already set brands? Is our product going to be competitive and have the edge that would be able to put it above other products? And then is that market already saturated? With that, we're going to use those ideals and then start doing research and collecting extensive data on those. And with that research and data, we can start to create actual forms, those being the pro forma income statement and the pro forma cash flow. We want to input that data into these in order to see basically a blanket structure of, on the income statement, costs versus estimated profits over time. We're going to be looking at the EBITDA, which is the earnings before interest, taxes, depreciation, and amortization. And the reason we're going to look at the EBITDA on that income sheet is because that shows us the revenue generated from the operations, and it's not going to include things like taxes and depreciation, which should remain relatively consistent with introducing a new product, so we don't want that to skew any views in that sense. We're also going to make a pro forma cash flow, and that's going to show the cost associated with the new product as well as the equipment, facilities, and assets that are going to come with it. If we're starting a new product, it's the assumption that we're going to have to get a lot of equipment and maybe a lot of new assets to be able to start that production running. Those assets as well are going to depreciate over time, and hopefully we'll be able to get tax write-offs and have liabilities with those assets as well that we generated in our pro forma statements. We're going to be able to calculate the payback period, and the payback period is how long it's going to take for us to make our money back from those early expenditures. The discounted payback period is how long it's going to take us to make that money back, with the consideration that we're going to be paying back those investors. If your discounted payback period number is higher than your payback period number, you're going to want to reject the project, because that means that it's not covering its own costs before the investors are paid. Your net present value, on the other hand, is your estimated future value of cash inflow versus your costs, with the considerations of present and future values of that cash. You want your net present value to be greater than zero, because that means that project is making more than the capital costs. If it's not, then it's actually destroying value over time. Additionally, we may want to look at the internal rate of return, and that's the discount rate that would cause that net present value to be zero. So we want a net present value greater than zero, but this is showing us what it would be to make it to zero. So that means that you want that internal rate of return to be higher than the cost of capital, meaning that would be a positive net present value or a positive internal rate of return. And that means that that project, as we said before, is generating more than it costs. The modified internal rate of return is the rate that makes product terminal value and the absolute value of the costs equal. And so that means the net present value will be zero. That means that the MIRR should be lower than the internal rate of return. That's because it's removing the assumption that cash would be reinvested in the internal rate of return through that calculation. But it should still be higher than your WACC, or your cost of capital. To go more into the WACC, or the weighted average cost of capital, That's basically your costs from different funding sources, averaged and then weighted by the amount of usage. It's used as the discount rate for valuing projects. And it can be adjusted subjectively. It can be for higher projects raised or for lower projects decreased. And that's basically going to affect things such as your MPV, your payback periods, and your MIRR. You want to use that weighted average cost as a hurdle rate, basically, for your IRR and your MIRR. You want it to be higher than that. Because there's always going to be risks in you starting a new project, because you have the risk of losing money with that product. So, in review, we went over what kind of qualitative thought processes we wanted to go through in a new product, the size, the market, etc. We got that research and that data, and then we put it into our pro forma statements. And we used those statements in order to make the data show what kind of numbers we're looking for, whether the product would be profitable, looking at things such as the payback period and the IRR. And then lastly, we talked a little bit about risk and how we want to try to mitigate risk to an extent, and understanding what the WACC can do for us in those formulas. These are the references I used today. Thank you, and have a great day.